market movers. This is The Pulse.
Good morning, everybody. This is The Pulse. Thursday morning, I'm Anna Edwards here in London. US President Donald Trump used his primetime address to try to sell the Iran war to the American people and said the conflict is, quote, very close to completion. But he also warned that the US plans to launch fresh attacks within the next 2 to 3 weeks.
We are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong. In the meantime, discussions are ongoing. Regime change was not our goal. We never said regime change, but regime change has occurred because of all of their original leaders' death.
For more, we're joined by Bloomberg's Washington Deputy Bureau Chief Laura Davison with us this morning. Laura, what were your key takeaways then, listening to the president?
So the key takeaways here is that Trump is keeping his options open, really, as he has for several weeks. He said they're going to ramp up attacks in Iran for the next 2 to 3 weeks. And at the end of that period, he wants a deal. But if there's no deal, then he will order strikes on electricity plants within Iran, which would be a major escalation of this war. So we have seen, Trump sort of send a lot of mixed signals, a lot of mixed messages about both what he wants, what he's looking for from Iran, and whether or not, what the state of these negotiations are with Iran. We saw the same, scenario play out here in what was a more formal speech than what we've seen from the president, but there were really no new details, nothing else to really shed light on what exactly is the plan to get out of this war. He had previously suggested the U.S. would withdraw within 2 to 3 weeks. He didn't quite say that. He said that there would be sort of a stepped-up military campaign until then, but didn't give any specific timeline for when the war would end.
Yeah, and the president has made some quite conflicting statements about the role of the Strait of Hormuz in any withdrawal of U.S. troops or escalation of activity in the Middle East. So what did he not clarify in his speech?
He did not at all clarify what role the U.S. would have going forward with the Strait of Hormuz. Instead, he suggested that it was up to other countries, Europe, Asia, Gulf allies, to go in there and take the oil and open it up. And he said they needed to get courage to go ahead and do this. This is really a pivot from what we've seen, just a couple weeks ago, where he was, trying to rally allies to, get military ships into the region to open up the Strait of Hormuz. He now seems to have completely washed his hands of that and says he's walking away and it's not the U.S.'s responsibility. Of course, the U.S. relies on oil from the Strait of Hormuz, that passes through the Strait of Hormuz, much less than some other countries. However, because of global oil markets, this means that energy prices around the globe are going to remain elevated as long as that is closed. So while the U.S. may not directly be affected by that specific oil sitting in the Gulf there, it is still going to be a political problem and an economic problem for Trump back in the U.S.
Yes, and so now we see more than 30 countries being convened, Laura, to talk remotely, I think, about what level of involvement they might want to have in the Strait. Also addressing the American public, in the hours before we heard from President Trump, we heard from the Iranian president. He wrote a letter that was supposed to be, he hoped, widely published in the United States. What were the key messages there?
So the messages here were that essentially that the American leadership is not to be trusted. He said that Americans, this letter was directed specifically to the American people, that they should look past the White House's rhetoric, and that there is Iran has a long history, and that the history between the U.S. and Iran is much understood. And essentially this was a very unusual move to see, and you really see Iran sort of using some of Trump's similar tactics of going out saying that Trump is adopting this maximalist position, sort of really punching back at him in a way that you see Trump take to Truth Social or other social media and lambast allies. So this is, was interpreted very much as a sign of strength from Iran, that they're willing to go toe-to-toe rhetorically with Trump.
Laura, thank you very much. Bloomberg's Washington Deputy Bureau Chief Laura Davison. Joining us now on the programme with analysis, Shoqat Bunglawala, who's Head of Multi-Asset Solutions for EMEA at Goldman Sachs Asset Management. Shoqat, nice to have you with us. Thanks for joining us. I see so many references to fog in lots of research reports right now because there's, famously the fog of war, and that seems to be being picked up by many investors to describe an inability to have a lot of conviction about what happens from here. How is that fog influencing you and the choices you're making? Sure.
Firstly, thanks, Anna, for having me. So we'd gone into this year expecting above-trend global growth. US growth at probably around 2.5%. We were expecting European growth to be above trend. There was the prospect of easier financial conditions with the Fed potentially cutting in the second half of this year. That disinflationary trend that we saw last year before the tariffs, we were expecting to re-establish itself at the second half of this year as the tariff noise faded, and there was the fiscal support from the One Big Beautiful Bill in the US, as well as German fiscal stimulus here in Europe. And that's clearly been clouded. There's a number of risks now, and those include, of course, the conflict in Iran. It includes events in the credit cycle. It also includes some of the twin concerns in AI, both as it relates to return on investment as well as some concern around the impact on the labour market. If you take the first of those risks, as you've been discussing with the conflict of Iran, it's both a function of duration as well as magnitude of impact. On the one side, there's an uncertainty associated with the duration. We've already seen the impact as it relates to shipping being incredibly limited through the Strait of Hormuz. Kuwait, which has significantly reduced oil production, has already said it could be many months before they get back to full production. But there's also the potential for, obviously, escalation. There could be impacts or challenges in the Bab el-Mandeb Straits. There's already been an impact on energy infrastructure in Qatar with the Ras Laffan plant, and they've already indicated that some element, some proportion of that supply is going to take many years to get back into the market. So the concern on this clearly is around duration and potential magnitude. That's having an inflationary effect. We've seen that more impactful in Asia and Europe, where they're just that bit more dependent, of course, on importing energy, and that's consequently had an impact on the path of policy rates.
Yes, absolutely. And there's a lot to think about there. So you started by outlining the growth expectations that you had before the war, before this particular risk loomed on agendas, on investors' agendas. So you expected above trend growth. What's your expectation now? Is it trend growth or is it well below trend growth, given the scarring, perhaps, to some of that energy infrastructure that has already taken place?
Sure. So we're now expecting trend growth. There's been some clear deterioration, but it's been modest, and that's why we're expecting trend growth. But we're acknowledging that the range of outcomes from here are quite uncertain. Those risks are obviously, any one of those risks could have a significant tail event, so it's worth certainly monitoring.
Yeah, absolutely. I mean, the other things that you mentioned, are they still, we're thinking about the AI story, for example, because, how much is that providing some upside at a time when clearly a lot of investors are nervous, risk off? In today's markets, substantially so. How much upside can the AI story provide through this? Because, I mean, there are links, aren't there? Energy is one of the key requirements of the AI rollout.
Absolutely, yeah. It's certainly very dependent on energy. I think there's a significant degree of AI capex, which is certainly supporting growth, and we expect that to continue. In terms of concerns, there's still a challenge as it relates to the forecast around return on investment, and there's also a challenge as it relates to the potential impact on labour market supply. On the second, with respect to private credit and some of the events in the credit cycle, we've also noticed some AI disruption there, particularly as it relates to the software sector, and that's had a material effect. But with private credit, I think it's important to distinguish on the one side sentiment and the other side fundamentals. There's been some concern around redemption activity in these open-ended private credit funds, particularly in the US with some pretty large funds, but we think that's sentiment driven. That's more about, can investors achieve their redemptions, or are these funds going to impose their stated caps? That's more about the extent of liquidity that these funds hold and about fair treatment of investors given their pool funds. We don't think that's related to fundamentals. On the fundamentals, I think it's important to continue to monitor the potential impact as it relates to AI disruption in software sectors, the potential for increases in defaults. To date, it's been quite limited, and also assessing for whether or not there's any reduction in broader lending from banks. But we do think that that's contained. We don't see a spillover effect into broader risk assets at this stage.
And let me ask you about diversification, because clearly that means very obviously diversification across different asset classes, maybe within equities and credit, different sectors, that kind of diversification. But you make the point in your notes, it's also about tail risk hedging, so protecting yourself from some pretty unlikely things, but things that could happen, and trying to find uncorrelated assets. How hard is that right now?
Sure. So I think as multi-asset investors, diversification is obviously very important to us. We think there needs to be multiple types of this. So we've seen the typical sort of ballast that you get from bonds, which are, you're seeking negative correlation to equities. Doesn't always play out. It hasn't played out in this environment, given bond yields have moved up. So firstly, seeking some element of tail risk protection, focusing on asset classes that are perhaps unduly impacted by a prolonged energy supply shock, and therefore buying protection in areas like European equities, we think is prudent. Secondly, recognizing that there could be a market debate around the potential speed and magnitude of central bank policy reaction function, but then also a fiscal response that impacts longer-term bond yields, means that you can seek to take advantage of rates volatility and looking for that protection from larger swings in bond yields, and that can be an uncorrelated source of return in portfolios as well, and that's one of the other things we're doing.
Yeah, I talked earlier about that volatility in bond markets with an FX guest who was talking about the dollar on the back of that and saying there just doesn't seem to be much that stops the dollar right now. Certainly going into a weekend, that seems to be the case. What's your thinking about the role that the dollar is playing in this particular crisis?
Sure. So I think with market moves, we've seen with a more than 50% increase in the price of oil, we're now sustainably above $100 a barrel. You've seen dollar strengthen. You've also seen European and emerging markets equity fall around 10 to 12%. That's more than what we've seen, of course, in the US, which is down around 7% or so. Bond yields have moved up, IG spreads are up, high yield spreads are up about 30 basis points. All of those are probably natural things that you'd expect. But one important thing to also look at is look at the sector composition of equity market returns, particularly in the US. 5 of the 11 sectors are still actually up year to date, not just energy, which is up substantially, but consumer staples, industrials, materials, utilities. And that's suggesting that the breadth is actually still quite robust. Russell 2000 small cap indices up year to date as well. And that's also supported by very positive earnings growth. We saw double-digit growth last year. We're expecting double-digit growth again this year. And that's one of the reasons why we're still constructive over the medium term. So notwithstanding this element of dollar strength as a safe haven, which is reflecting near-term uncertainty, with the overall medium-term outlook for us is still quite constructive.
OK, thank you very much for your time. Thanks for joining us. Shoqat Bunglawala, who is Head of Multi-Asset Solutions for EMEA at Goldman Sachs Asset Management. Coming up on the programme, 1 year on from President Trump's Liberation Day tariffs, and the turmoil is not over. We bring you details on how he plans to target the pharmaceutical industry. That's next. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, Friday on Bloomberg.
This is The Pulse. I'm Anna Edwards, live in London. NASA astronauts have blasted off on a 10-day mission around the moon, marking a humanity's return to the lunar neighbourhood for the first time in more than 50 years. The US and China are racing to put humans back on the moon too, with NASA working to build a lunar base. Bloomberg Tech co-anchor Ed Ludlow sent this report from the Kennedy Space Center in Florida.
4, 3, 2, 1. Booster ignition.
That was the moment that NASA sent astronauts back toward the moon for the first time in more than 50 years. Artemis 2 is a dress rehearsal, first for NASA's Space Launch System, or SLS, developed by Boeing, which generated almost 9 million pounds of thrust when it lifted off from Kennedy Space Center, Launch Complex 39B, here in Florida. Initially, there's this 2-day orbit of the Earth at different altitudes, practicing burns, practicing manual control of the Orion spacecraft before a translunar injection. That then puts the crew on a slingshot around the far side of the moon. 250,000 miles of distance, a total round trip of 685,000 miles, at one point 4,000 miles from the moon's surface. And in that time, the crew on board are going to be practicing maneuvers, manual control of the spacecraft, communication systems, emergency procedures, because Artemis 2 is just one step in a bigger picture plan to return astronauts to the moon's surface, potentially as soon as 2028. That is America and NASA's goal. And it's been an expensive enterprise, $4 billion per launch, a $93 billion program cost. And it's a race against China, who have their own ambitions to land on the moon. They've stated 2030. The crew of Artemis 2 are expected to splash down on the west coast of the United States in 10 days' time. This is Ed Ludlow for Bloomberg News at Kennedy Space Center in Florida.
Let's get some further thoughts on this quite historic event, really. Bloomberg's global defence editor also covers the space beat for us. Jerry Doyle is with us on set here in London. Jerry, good morning to you. So how much relief, then, do you think there'll be that this went as planned? I mean, these things don't have to... not everything you do in space is crude, but this was crude, and it's really historic because it's going further, deeper into space than has been done in decades. So a lot more attention on this than perhaps usual.
Yeah, absolutely. Crewed spacecraft. Crewed spaceflight is very hard. Getting off the ground is arguably the trickiest part of a mission. There's a lot more stress on the spacecraft and the vehicle. So the fact that they were able to carry it off, everything went off without a hitch, no technical problems there in orbit. I think everybody is breathing a sigh of relief at this point.
Yeah, breathing a sigh of relief. And a longer term, bigger picture, how important then is this for the future of the NASA space program, for space travel, for those American ambitions in the sector?
I think it's tremendously important. It's going to prove a lot of technology, a lot of procedures, a lot of techniques for operating in orbit, getting things to and from the moon. A lot of different things are going to be sort of proven on this spaceflight. And if it all goes off without a hitch, and eventually in a few years there are people back on the moon's surface, maybe that will lead to steps farther into the solar system.
What about the European dimension to this, Jerry? I'm not sure if that's something you follow particularly closely, but this was obviously a US NASA mission, but is a US project. But it has international involvement, not global, not China, not Russia, but it does have some global contributions, in particular from Europe. I spoke to an politics professor yesterday who was saying that there is a bit of a risk, though, for Europe, that its role is not quite certain. It was hoping to be involved in the Gateway space station that was going to be next to the moon, essentially, but that might be scrapped, and if that is scrapped, Europe's role isn't clear. I mean, what expectations do we have for Europe and its role in this particular version of the space race?
Well, there is some European technology in the hardware that is going to and around the moon. At the moment, NASA does not seem to be planning to do the lunar gateway, the sort of the orbiting station around the moon, and that has sort of led to some disappointment because there was going to be additional European technology in that. However, as the plans for a lunar base become real or become closer to being real, I think there should be some opportunities for European companies and the European Space Agency to get involved.
And we were talking about, decades ago, when this was being done for the first time, this was all part of the Cold War, and it was about a Soviet-US rivalry. Now there is rivalry on space ambition, certainly with China and to some degree still with Russia as well. What do we know about how much this advances the US cause versus the others?
It's hard to say. I mean, it feels like the U.S. Artemis program is closer to actually putting people on the moon than the Chinese space program, which has landed probes on the far side of the moon, which has ambition for a lunar outpost at one of the lunar poles. So, you know, to the extent there's a Cold War feel to this, it feels like if there is a space race back to the moon, maybe the U.S. is slightly farther ahead. But I think the stakes are somewhat lower than they were during the Cold War. The moon has been visited before by humans, so it's not as much of a milestone as it was in the 60s.
Yes. I wonder how inspiring this will be for people watching it. It's often talked about in those terms. People who got into space decades ago will talk about it being, you know, on the back of the lunar landing. Remind us what the purpose of this trip is, because this isn't actually to land on the moon. The purpose of this, Artemis 2, is to test a lot of the kit that will be required.
Correct. It's sort of a shakedown cruise, right? So they're not landing on the moon, as you said, but on this 10-day journey, they're going to spend, you know, 5 or 6 days getting to the moon. They're going to swing around it, passing as close as about 4,000 miles to the lunar surface. And en route, they're going to practice some techniques, some processes, maneuvering the spacecraft. They already did that in orbit, sort of testing how well it flies in space relative to the simulators that they've done on the ground. They test other maneuvers, test communications and other technology that they're going to need to function perfectly if they're going to land on the moon.
Thank you very much. Thanks, Jerry. Thanks for joining us. Bloomberg's global defence editor, Jerry Doyle, casting an eye over all things space-related for us this week. And there's been plenty of news on that front. Also, lots of news on the energy markets. We talk a lot about what happens in crude markets, but some of these refined products we need to mention as well. European diesel futures hitting $200 as the Iran war limits fuel supply, and it is crucially some of these refined products that are being hit, and jet fuel, diesel, some of the prices there going higher or moving more than we've seen for the crude unrefined products. So we keep our eye on that. Europe generally produces less diesel than it consumes, and so it's particularly exposed to what comes out of the Gulf. Now, the Trump administration, on another beat, is said to be weighing new tariffs on drug makers and preparing to overhaul its steel and aluminium tariff policy. This comes 1 year after President Trump announced Liberation Day tariffs. We remember that well. Brendan Murray, our Bloomberg trade czar, also remembers that very well. Brendan, thanks for joining us once again. So what's behind the moves on drug makers? Get us up to speed there.
Yeah, so this is just a reminder that the Supreme Court took away only one of Donald Trump's tariff authorities, and that he's got all these others that they've said that they're going to roll out. So the pharmaceutical tariffs are going to come from a 232, this national security investigation, and the goal that President Trump has said is to encourage drug makers to make those medicines in the U.S. And so a lot of those companies have done deals and pledged to manufacture in parts of the U.S. They've said that they were going to cut drug prices as part of these deals. But this is the administration following through and making sure that those pledges are upheld. Otherwise, 100% tariff on pharmaceutical imports is going to hit them hard.
And what about the other sector we're getting news flow on, and that's aluminium, aluminum, and steel? What's the aim there?
Yeah, exactly. So these predate the Liberation Day. They came very soon after President came into office for a second time. They have been added to. There are products that have been added to the application of those tariffs, and it's an extremely complicated thing for importers to figure out what is the tariff on this tiny little component of metal in this product that I now have to declare and pay a tax on. So the administration has heard those concerns and is trying to simplify the situation.
OK, so simplification is the aim of the game. And Brendan, thank you very much. Brendan Murray, Bloomberg's trade czar. It has been a very heavy week for news. If you need something new to think about, we'll talk about the business of sport next. Ahead of next week's Masters, we're going to be talking about the outlook for professional and amateur golf. Guy Kinnings will be with us, the CEO of the European Tour. He's up next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Anna Edwards, live in London, and these are your top stories. Oil jumps and stocks fall after President Trump threatens to hit Iran, quote, extremely hard over the next 2 to 3 weeks, with no clear timeline for de-escalation. Air France-KLM submits the first known bid for a stake in the Portuguese flag carrier TAP, with the broader sector under pressure from higher oil prices. And back to the moon. Humanity set to return after more than 50 years as Artemis 2 launches an historic 10-day mission beyond Earth. Let's get back to the corporate agenda then, 9:30 here in London. Welcome back to the programme, everybody. Let's have a quick look at where the shares of Puig are trading. This, of course, the beauty brand listed over in Spain, is actually up a couple of tenths of a percent, which isn't a bad performance when you consider the wider markets are considerably weaker today. So the Stocks Europe 600 is down by 0.9% for reasons to do with war in the Middle East. But we do see some outperformance then coming through from Puig. Let's get to the story then. Bloomberg News has learned that Estee Lauder and Spain's Puig are advancing discussions to combine their businesses, a move that would create one of the world's largest luxury beauty players and perhaps reshape the sector. For more, let's bring in Bloomberg's French luxury reporter, Angelina Rascouet. Angelina, what more can you tell us about this potential deal?
Hi there, Anna. Yes, indeed. I mean, as you said, they're holding. Bloomberg reported that they're holding advanced talks about what could be a stock deal, essentially. Marc Puig, who is the executive chairman of the Spanish group, would likely have an important role in the future governance of the combined entity with a board seat. As you said, it would create the largest beauty player. Obviously, there's no guarantee that the deal talks will succeed. So we have to wait for what happens. Remember, these are two businesses, Estee Lauder and Puig, which are controlled by families, the Lauders on one side and the Puig on the other side. And since the deal talks leaked on March 23rd, Estee Lauder shares have fallen about 18% in New York and Puig have gained about 11%.
Yes, so that move higher in Puig continues today then, but just marginal compared to what's already been achieved. I mean, you're in Paris, Angelina. Normally we talk to you about the French fashion industry. No doubt they will be watching this potential deal very closely because this could reshape the industry to some degree.
Yes, indeed, Anna. I mean, basically the backdrop is that L'Oréal last year clinched a crucial beauty deal with Kering, a €4 billion beauty deal. So basically it's getting the perfume brand Creed. It's also going to keep on developing the perfume brands of Balenciaga and Bottega Veneta, which are the fashion brands that belong to Kering. And eventually it'll have the Gucci beauty license, which is right now with Coty, but that license will soon expire. So L'Oréal, which was already the market leader in that category, is going to be, in beauty, is going to be even stronger. So on the Puig side, it likely felt that it needed to be part of a bigger group. You need to scale. Puig has beautiful, perfume brands. It's got Jean Paul Gaultier, Rabanne. It also has the makeup brand Charlotte Tilbury. But basically, you're going to have more leverage when you're going to be negotiating with distributors. On the Estee Lauder side, it was probably a more surprising move because Stéphane de La Faverie, the CEO who took over in January 2025, he was tasked with turning the ship around, with probably cleaning up. There was a strategic review going on. So it's likely why also investors are, have reacted negatively because they weren't probably expecting him to shed some assets instead of going on a transformational transborder transatlantic acquisition, combination, which likely carries a lot of execution risk. And, the backdrop is also the turmoil that we're seeing and, high oil prices, what's going to happen to consumer budgets.
Angelina, thank you very much. Thanks for the update. Bloomberg's French luxury reporter, Angelina Rascouet, joining us there from Paris. Let's move on to another corporate story, and one that is a very well-read story on the Bloomberg terminal for reasons that will become clear. The British entrepreneur Nick Candy has sold his family home in London's Chelsea district for more than $350 million. It is believed to be the biggest single house sale in history. I'm not talking just about London here either. For more, we're joined by Damien Shepherd, our residential real estate reporter. Damien, what more can you tell us?
Yeah, look, Anna, this is quite literally what they call a mega deal. We don't think we've ever seen this type of a deal anywhere in the world in terms of the value. It's a estate essentially bought in Chelsea, and that's by an unnamed buyer. The seller, Nick Candy, the well-known property developer who was at the heart of the One Hyde Park development in London and is now up to all sorts in the luxury space in Dubai too. Now, to put this into perspective for viewers, this deal is worth something in the region of about £265 million. The biggest deal in London last year was £41 million. So this is a massive deal, something we've not seen in a long, long time. The biggest one before this was £210 million in 2020. That was a mansion overlooking Hyde Park called Rutland Gate. But yet you can't play this one down, Anna. This is a massive deal, and it's a big deal for the London market too.
Yeah, absolutely. What does it mean for the wider market? How does it fit into the broader trends that you're seeing, Damien?
Well, look, last year was defined by changes to the non-doms regime, different tax hikes sort of affecting the flow of wealthy individuals to London and the UK. Now we're seeing, the conflict in the Middle East potentially changing the mindset of wealthy individuals who've moved from London over to the Middle East. So now potentially this is a really good sign for the London market, and the fact that, a property has gone for this value might just give other vendors and buyers the confidence to say, hey, I'm pushing the button, I'm going now, and I'm moving forward with the deals that I've had in mind for a while.
Very interesting, Damien. Thank you. Thanks for bringing us the story and the incredible price tag. Damien Shepherd, Bloomberg residential real estate reporter. It's 9:36 here in London. This is The Pulse. Let's pivot to the business of sport. The Masters gets underway next weekend at Augusta National. But the first golf major of the year will be without Tiger Woods, who says he's stepping away to seek treatment after pleading not guilty to a DUI charge. The wider professional game also faces an uncertain future, with the flagship tours in the US and Europe yet to finalise any deal with Live Golf, despite agreeing to merge with the Saudi-backed tour in 2023. Let's think about where the sport goes from here. Guy Kinnings joins us, the CEO of the European Tour Group. Guy, really nice to have you with us. Thank you very much for joining us on the programme. If I could start with the sort of most recent developments, I guess, in the sport and globally, something we're talking about a lot and how it affects a lot of sectors. Events in the Middle East have an impact on any global business, and golf is a global business. Certain events have had to be rescheduled. What is the impact of this, do you think, on the golf business right now?
I think we're still to see exactly what it means. We ourselves we play multiple swings on our tour. We're kind of a truly golf's global tour. We played in the Middle East in January. We don't play again in the region probably until September, and we have some big playoff events in November. So we've got a little bit of time to see how things work out, and we will be ready. We speak to our advisors, our travel advisors. A lot of the players travel through there. A lot of the tournaments that we do around the world use it as a hub. So we've been having to monitor that, and we'll wait and see and hope that we'll be able to finish the season as we started it.
Yeah, OK. So unlike some sports which have imminent fixtures in the region, you're maybe a little cushioned from that particular eventuality. Let me talk about the wider golf landscape then, because for some years, certainly many months, we've been thinking about consolidation within the space. Live Golf emerged and quickly started to try to redefine the sport, and then we saw talks between Live Golf and the PGA Tour, and yet those talks have sort of ground to a halt and haven't seemed to go anywhere. I wonder, from your perspective, what are you looking at? What are your hopes for that kind of conversation within the golf world?
I mean, for us, we play the world over. We like to work with partners in different territories, and that's what makes us the global tour. We play double the number of countries. We play in double the number of countries. We have double the number of nationalities on our tour. And for us, all we can really do is to try and control what we control. We have a strong working relationship with the PGA Tour, a strategic alliance that's allowed us to invest in our product. And that product has never been as popular with fans and with sponsors. We have 5 global swings. We go into our back 9 and playoffs. We play national opens around the world. And at the moment, interest levels are extremely high in those. We've got record sponsorship levels, consumer levels are up. And for us, therefore, our focus is, let's make sure we do our product as well as we can.
Yeah.
Check that people are enjoying it, which they seem to be doing. We've maybe had maybe our best year ever in 2025. Rory McIlroy helped a little bit. His extraordinary win at the Masters, first sort of European to be a Grand Slam winner. We had the extraordinary events in Bethpage. Our Ryder Cup heroes there gave us the most watched TV golf event ever on Sky. So all of that's been good, and that allows us to do what we need to do with our partners.
OK, yes, because I suppose I was wondering whether the uncertainty that these ongoing conversations between the PGA and LIV create, does that uncertainty throw up opportunities for you, or does it mean that those who are interested in investing or sponsoring golf stand back and don't make decisions? Does it hold things back? What's been your experience?
Well, it's interesting. Golf in itself has never been more popular. We think it's just under 110 million people play around the world. Record numbers took it on since the pandemic. And for us, our product seems to be very popular right now. We have $300 million in sponsorship booked for this year. That means we've got about $1 billion in sponsorship contracted. Our consumer levels, so our fan engagement, people are watching, people are turning up at events, up 30% year on year. So for the moment, what we're seeing is there's an interest in the sport. There is an interest in those people who want to see it. For sure, we have needed to innovate. We've needed to bring in new fans, and we've done that by creating experiences. So it's not just putting on great golf tournaments. People have a great experience. What we'll put on in Adair Manor at the Ryder Cup in 2027 will be extraordinary and appeal to people in different ways. And we also we've been very lucky. We've been award-winning, 8 awards last year, but they've been in different areas, our delivery, but our content is probably almost our strongest. Our players create this incredibly appealing, virally appealing content that has drawn in a new audience.
Yes, and you talk there about innovation, and I wonder if all of the attention that LIV Golf received and the questions it raised about what the professional game should look like, did that open up an opportunity to have conversations that maybe you couldn't have before about what the game should look like, about risks that should be taken, about innovation that should be brought in? Has it moved things forward?
I think it has. I think we always have to improve. Our sole goal is to service the members of our tour, improve the tour year on year. Absolutely, challenges and people who ask questions, make sure that you're always improving, innovating. We're kind of known to be the innovators. PGA Tour are very strong, great partners of ours. You've got LIV, but we are the global tour, attracting talent from across the world, and we do it often in kind of different ways. We go to more countries and we go to different geographies, appealing to different demographics, and that's always a good thing. Golf can be shown in lots of different ways. We play standard stroke play, we have match play. The Ryder Cup is almost this extraordinary event, attracts an audience all of its own. So it is up to us to kind of keep making sure that we innovate to attract that audience and keep that audience.
Yeah, you mentioned the strategic alliance that you have with the PGA Tour. As part of that agreement, the PGA Tour acquired, I think, 15% stake of European Tour Productions, rising to 25% in 2027. Are you open to selling more of these kind of vehicles to investors? How has that particular arrangement played out for you?
The relationship with the PGA Tour has worked incredibly well. There were lots of synergies. It made a lot more sense for us to be working with them rather than against them. We looked at private equity before we decided we would work with the PGA Tour, and it's worked very effectively. And we've shared in some of the projects that we work on together, and we're looking to continue to work in that way in the future. I think that the sport, I think golf, which has a very strong, valuable audience, and is very appealing to people. It is the sport of business, and people get to do things. The Pro-Am is a unique opportunity. Handicapping allows people to play with their heroes. So the sport is in really good health. I think that means it's attractive to investors. For us, we have a great working relationship, and my job is to make sure that we do the best thing for the members of our tour.
Yes, and I know we want to focus on what you do and not what others do, but clearly it's such an unknown, the LIV PGA relationship hanging over the sector. I mean, what do you realistically expect the end of this to look like? Are we in stalemate? Does it go anywhere?
I mean, in essence, those are decisions to be made by the two parties. We, as it were, sit there working closely with the PGA Tour, but equally we have players, members of our tour who play on LIV. We've shown that we're ready to be inclusive, and for us the most important thing is control the controllables. What can we do? Take our product around the world, make sure it's as appealing as it can be to sponsors and to the audiences, and then hope. I mean, we are very much the funnel for global talent. Because we're in so many countries, the best young players tend to gravitate onto the DP World Tour, and some of them then graduate onto the PGA Tour. So for us, all we want to do is to continue to be that focal point for global talent.
OK, Guy, thank you very much. Thanks for coming to speak to us. Thanks for bringing us the story. Guy Kinnings, the CEO of the European Tour Group. Good to talk golf this morning on The Pulse. Coming up on the programme, we'll get back to the market story. And the market story that is moving this morning is, of course, related to war in Iran. It's hitting global aviation, from soaring fuel costs to grounded flights. We'll get an update on that particular sector. Travel disruptions to look for. This is Bloomberg. Welcome back to The Pulse. Now, the disruption from the Iran war is impacting economies and industries across the globe. In a moment, we will discuss the disruption to the aviation sector. But first, let's look at what this means for inflation and the construction sector in Europe. Joining us now is Angelica Donati, who's Managing Director at the property development company Donati. And nice to have you in London. Thank you very much for being with us. So bring us your perspective then on real estate, the construction sector, and how it's coping with what we're seeing here. The Gulf conflict clearly has an impact on your ability to source certain materials. So let's start there.
Well, there's been a huge inflationary spike in all raw materials costs. So not just energy costs, which obviously are the most logical, but all materials from plastics to steel. I think the biggest headline we've had in Italy in the past few weeks is bitumen, which is basically road paving, surfacing material, which has gone up 50% in the first 2 weeks since the war started, which means that road paving projects are now up 25% in terms of costs. But not just that. Suppliers are just not delivering, so a lot of projects are now stalled. And because, unfortunately, as we've seen in the past few weeks, it doesn't seem to be a temporary increase, but something that's slightly more structural, even if the war were to end, you know, as we all hope, very soon, there is a big worry, there's a big underlying fear of the long-term effects that this will have on the sector, especially with delivery programs which are set on very tight schedules, considering that we also have the PNRR, the Recovery Fund investments, which are now supposed to be winding down. So we're in the last leg of that, and the delivery of that could be massively impacted.
Okay. Yeah. And so would you say, Angelica, that the sector is more concerned about the price it will have to pay for product, or the ability to actually get product at all? Is it going to be just a very expensive raw materials and things like bitumen, or is it going to be that you can't actually get it at all because there just isn't enough of it to go around the world?
I think a bit of both. So you mentioned bitumen. We do a lot of roadworks, and our suppliers are just not delivering at the moment. But then across the board, there is just a massive push on input prices, and unfortunately we don't have, Italy doesn't have a price revision mechanism which is automatic. Contracts that were signed before 2023 had no price revision mechanism at all. Post 2023 it's slightly different. We do have a compensation mechanism, but the industry is now calling for this to be amped up and speeded up because, of course, we can't forget that Italy is at a very important crossroads also on global supply chains. So our infrastructure is particularly crucial for delivery in this, troubled moment.
And yes, absolutely. And being in the Mediterranean, that's important, and its role in the port landscape. I wonder what businesses such as yours have learned from going through the COVID experience and then going through the invasion of Ukraine and all of these events globally that pushed up prices, pushed up construction prices, made supply chains more precarious. Is there a sense that companies are more resilient this time around? They know what to do in this situation, or the crisis is just different each time?
It's very different. It's different each time, and unfortunately what we've seen is that we're at our third shock in 5 years. So we had the war in Ukraine, we had Gaza, and we had COVID, so actually this is probably the fourth, and now we have this. And every time what we've seen is prices go up, but then they don't fully correct back down. So it kind of gets, the increase in costs gets baked in to our baseline. We are in a better position now than we were before COVID, because thanks to this important injection of, well, nearly 200
200 billion euros of investments into Italy, thanks to the PNRR, we were able to not just invest massively in our infrastructure and other key parts of the Italian economy, but our companies were able to reinvest in themselves and recapitalize. So we all come out of the COVID era much stronger. However, nobody's equipped for this kind of shock, and everything that's been put in place to deal with inflation, to deal with price shocks, is not built for this kind of spike and this kind of unpredictability, especially because we don't know when things will then normal out again.
Yes, I mean, this has been described by the IEA in quite stark terms. Lots of people talking about this as the worst oil shock since the 1970s. Maybe it becomes as bad in some ways as previous events like the 1970s. I mean, what are those who've been in the industry for a long time? What's the conversation like about how this compares to past crises?
It's interesting because I've read the research as well. Macquarie has said that if the war continues past June, we could see $200 a barrel, and that would be devastating for the global economy. We've seen inflation forecasts go up. The OECD has now said that inflation on the G20 level will be 4% this year. Data for Europe and Italy has been going up already month on month. But I don't think anybody has quite factored in how dangerous this is. From what I've been reading, what I've been seeing, it's still being seen as a short-term spike and a short-term crisis, whereas it's very clear that even if the war ends tomorrow, as we were saying, the long-term consequences will last and will be quite strong. And so I think we need to start thinking now of what we can build in structurally to support the economy, support our key sectors in this transition period out of a kind of low inflation state to a high inflation state.
Angelica, thank you very much. Thank you for joining us. Good to hear from you. Angelica Donato, Managing Director at Donati. Let's pivot to the aviation sector then, another sector that's being hit, of course, by all of the developments in the Persian Gulf. Shares in Air France-KLM are lower this morning. That's after the group kicked off the race for TAP, submitting the first known bid for a stake in the Portuguese flag carrier. It comes amid the war in Iran, disrupting global aviation with soaring jet fuel prices, airspace closures and widespread flight cancellations hitting airlines worldwide. Kate Duffy is our aerospace reporter and joins us now. Let's start with the M&A story, which perhaps is quite incredible timing or maybe opportunistic. Kate, what can you tell us about the bid to acquire TAP?
It is. Well, 3 airlines have been in this race for over the past year now to acquire TAP. So this is the Portuguese flagship carrier. It's one of the last medium-sized private airlines in Europe, and it's got a great network with strong demand into South America. So ultimately, that will build out one of these 3 airline groups that are going for it at the moment. That is Lufthansa, Air France and IAG. So far, Air France is the only one to submit the non-binding offer. The deadline is today, so we're still waiting for Lufthansa and IAG, but we have heard that IAG and we've reported that they're likely to abandon the deal. So we will find out in the next couple of hours as to what the decision will be. So yes.
And so what further impact to travel disruption can we expect over the coming weeks? So pivoting to the effects of the war in the Middle East, paint a picture for us, Kate. What are you hearing?
Yeah, I mean, it really depends on how long the war lasts, of course. We've seen a lot of airspace disruption in the Middle East. A lot of the Middle Eastern carriers are really struggling with the missiles flying around and having to operate and avoid all of that disruption. Many of the European carriers have, redeployed their aircraft out of the Middle East and put those aircraft into other routes, existing routes into Asia and the US. And US carriers, although they are on the other side of the world, they've also been affected by this in terms of they don't hedge any oil, and therefore their prices are rising. Having said this, executives have said that transatlantic demand is strong and people are booking a lot of tickets during this period. And this could be because of the fact people are trying to lock down these tickets before they increase even further in price. So lots of movement in the sector at the moment.
Yeah, we've certainly seen phases and periods where there have been explicit surcharges for fuel, haven't we, Kate? So we'll see how that develops. Our aerospace reporter, Kate Duffy, thank you very much. European equity markets then on the back foot this morning. US futures also reflecting that negativity, a re-escalatory interpretation of what we heard from President Trump. So that seems to be where the market is focused, and so futures pointing lower this Thursday. Have a good long weekend, everybody, if you're getting one. Bloomberg Brief is up next. This is Bloomberg.